Hey everybody, I'm Logan Alec. I'm a CPA. In this video, I'm going to be walking you through IRS Schedule C, Profit or Loss from Business. You're probably familiar with this form. It's the form you have to fill out and attach to your 1040 if you earned income from self-employment. I'm going to be walking you through this form line by line, telling you how to fill it out. Of course, I'm speaking here in general terms. This is not tax advice. I am a tax advisor. I am a CPA, but I'm not your tax advisor. I am not your CPA. I'm just going to be sharing this information with you for general informational and educational purposes. First of all, though, before I get into the line by line stuff, who needs to fill out a Schedule C? Let's look at the Schedule C instructions for that answer. Use Schedule C to report income or loss from a business you operated or a profession you practiced as a sole proprietor. An activity qualifies as a business if your primary purpose for engaging in the activity is for income or profit, and you are involved in the activity with continuity and regularity. For example, a sporadic activity, a not-for-profit activity, or a hobby does not qualify as a business. To report income from a non-business activity, see the instructions for Schedule 1 of Form 1040. It goes on Schedule 1, okay, as other income. Now, why does this matter? It matters because the net income you report on Schedule C is generally subjected to self-employment taxes. That's an additional tax in addition to the regular income tax. I don't know why the ring light is visible in the frame. Sorry. As opposed to income you put on Schedule 1 as other income, it's not subject to self-employment tax. So it's actually more advantageous for you if the income is on Schedule 1 than on Schedule C. But you can't just pick and choose, right? You have to use facts and circumstances to determine if the income we're talking about here should go on Schedule C or Schedule 1. Case in point, I sell trade lines, right? You put people on your credit card as an authorized user so they get a little credit score boost, okay? And I do that to make a little side money. Okay. Now, I would say, look, if you're doing that, if I was to engage in that, like, maybe once a year, twice a year, 3 times a year, just kind of sporadically here and there, I might have an argument that I should put it on Schedule 1, right? But since I do that every month, since I actively talk about it on my YouTube channel, right? It's probably a business. My primary purpose for engaging for the activity is for income or profit, and I'm involved in the activity with continuity and regularity. So that's just one small example. All right, I don't want to get too much into, should it go on Schedule C or not. I mean, realistically, if you're out there, you're driving for Uber, you're a freelancer, you're on commission somewhere, you're a commission-based salesperson, right? You're on 1099. You're probably looking at Schedule C. 1099 NEC is now the typical form that's used to report non-employee compensation. Obviously, if you're an employee, your boss should be giving you a W-2 after the end of the year. Okay, not a 1099. Anyway, let's get down into it. Name of proprietor, right here. Why isn't it? Oh gosh. Here we go. Okay. Name proprietor. I would just put my name, right? Logan Alec. Social Security number. This is obviously not my real Social Security number. This would automatically populate from your tax software, by the way. Next thing, principal, business, or profession, including product or service. IRS isn't going to be too picky about this. If you want to get technical, look at the instructions here. Give the general field or activity and the type of product or service, right? If your general field or activity is wholesale, retail, trade, or services connected with production services, also give the type of customer or client. For example, not just wholesale trade of hardware to retailers, or appraisal of real estate for lending institutions, right? But I'm not going to tell you to not do what the IRS says, but, let's just, what was it? Appraisal for real estate lenders or something like this. Obviously, I'm just making this up. Then you got to put the code from the instructions. This code here is at the back of the Schedule C instructions, like in the very back here. All these codes. You got to look for the one that corresponds the closest to your particular business activity. Right. So if in this fictitious example, I pretend to be a real estate appraiser, I'm not. I'm a CPA. Right. As a matter of fact, I'm not going to put real estate appraiser. I'm going to put CPA, and there's a separate one here for offices of certified public accountants. You can use Control F. Right. Offices of certified public accountants. Right. 541211. Okay. 41211. Okay. I'm just going to say I'm a CPA for, I'm going to say certified public accountant. Okay. Business name. Obviously this isn't my actual business name. I have a corporation called Choice Tax Relief, et cetera, but I'm kind of just pretending here I'm a one-man shop. Business address. This is actually the mailing address for my actual business. It's online, public information. Don't get too excited about it. Gosh, what is our suite? There we go. 70, Angeles, California, 017. So most of you all out there. So next EIN, right? If you have an EIN for your business, put it there. So you can have. If you have a single member LLC and you haven't elected, and that LLC is not elected to be taxed as a corporation or a partnership, not a partnership, elected to be taxed as a corporation, then you likely got an EIN for it, right? You can have an EIN though even without an LLC, right? Just as Logan Alec, right? I could go online and get an EIN from the IRS website. Okay, there are certain instances in which having an LLC is not an LLC, an EIN is required, right? For example, if you're doing payroll, okay? And there's a whole list on the IRS website of when you need an EIN. I'm not going to get into it. Most of you out there, you're driving for Uber, you're freelancing, whatever, you don't need it. Accounting method. Most of you out there are going to be doing cash, right? Meaning the number you put on the gross receipts line there is going to be the total amount of cash that hit your business bank account, right? That was for the services you performed, right? Or the products you sold. Let's say it's $100,000. Now you could, and same thing with the expenses. The expenses being the actual amount of money you spent on these expenses during the year. Okay. Now, some of you there, you might keep your books in QuickBooks or whatever on an accrual basis, which means you would book revenue as, say, you send an invoice, regardless of whether or not you collected the cash yet, right? So you send an invoice, boom, that's revenue. Okay. So, but most of you out there, you're on cash. Why? Because I work with a lot of Schedule C people. I know most of you guys are just on a cash basis. That's how you keep track of your stuff. Did you materially participate in the operation of the business? The answer is yes if you're running the business, okay? If you started or acquired the business during the year, check here, right? This is a new business. You check there. If not, you leave it blank. Did you make payments in 2024 that would require you to file Form 1099? Basically, if you paid, an independent contractor more than $600, you should have filed Form 1099. You should have given them a Form W-9. They filled out. You issue them a 1099. You select yes, right? If yes, did you or will you file the required Forms 1099? Hopefully, if that's yes, then this is yes. If this is no, I typically leave this one blank. All right, now you just fill out your numbers. Hopefully you're using something to track your numbers. Do your books, QuickBooks, Xero, spreadsheet, right? Nice thing about sole proprietorship, and as well as corporations and partnerships, with less than 250,000 gross receipts for that matter, is you don't have to present a balance sheet, right? You just have to present a P&L, which is fairly straightforward. Right? How much money came in and how much money came out categorized by expense category. Not rocket science. It's when you get the balance sheet That's when bookkeeping becomes a little more trickier, making sure that you're recording and tracking your equity and all that. Okay, so top line here, not too complicated, right? This is how much your gross receipts or sales. Okay, returns and allowances. So obviously, if you sell merchandise and you sold 100,000 and 2,000 came back to you because the customers wanted a refund. That's what you'd put there. And then you have cost of goods sold. Now, there's a calculation for this here. Okay. You're not really going to use this if you're selling a service, but if you're selling a good, like products, right, as opposed to a service business, you're theoretically going to be tracking inventory, okay, and adding to that inventory, and then kind of turning that cost of goods sold for each unit you sell, right? So you can kind of arrive at your gross profit margin up here, or your gross profit. Okay, if you're just a freelancer selling your graphic design services or something like this, you're probably not going to use COGS. Okay, but if you have inventory, and we'll get to this more on the next page, but that's what cost of goods sold is. So let's say you do have inventory. Let's say you sell T-shirts. I don't know. Let's say your cost of goods sold was 30,000. You have your gross profit here of 68,000. Your tax software will do the math for you, by the way. Other income, that's typically nothing there. So, all right, now you got all your expenses, right? Hopefully, in the way you're keeping track of your books, you're kind of tracking, what your expenses are. I'm just going to make up random numbers here. Okay, these numbers are not prescriptive. I'm not recommending that they're the numbers that you should use, but advertising, right? What you spend on marketing to get sales. Okay, it's probably more than that. Let's say, your Facebook ads, your newspaper ads, right? Stuff like that. Now, I'm using round numbers here to make the math very easy. It is not a good thing if all your numbers on your Schedule C are round, right? Because that's an indicator to the IRS that these are not exact numbers. These are kind of just numbers you might have made up off the top of your head. Matter of fact, let me just go back. I know this is kind of a pain in the butt, but let me, oh gosh. No, forget it. I'm just gonna use round numbers. But on your actual Schedule C, you want to use actual numbers to the dollar, not 5,000 or whatever this nonsense I'm doing here. Car and truck expenses. Now, there's a couple ways of doing it. There's standard mileage and actual mileage. Okay. Regardless, though, you got to fill out this information if you used your vehicle in your business. Okay, in Part 4. So, let's say this is your T-shirt business, and let's say, you're doing your own deliveries, right? You have your office that you work at, and maybe that's where you store your inventory. But then you go out and deliver to customers around town. I don't know, whatever, right? You can just add up all the number of miles you drove during the year. Let's say it's 10,000, and multiply it by the standard mileage rate for the year. For 2020, and you can just easily Google this. For 2024, that's 67 cents per mile, right? So if you drove 10,000 miles, that would be a $6,700 expense. Or what you can do is you can say, okay, I drove 10,000 miles for business. I drove 10,000 miles for personal. So half of all my vehicle expenses were for business, and you can add up all your vehicle expenses during the year: insurance, gas, maintenance, tires, all that stuff. Multiply that by whatever that percentage is. In this case, to make the math easy, I'm saying half, right? And put that here. Oh, but wait, don't forget depreciation. Okay, so you can take half of the cost of your vehicle. Well, it's a lower cost or fair market value when you place it in service for the business, right? So you can't say, oh, I bought this this car for $30,000 20 years ago, but now it's only worth like $5,000. If that, you have to use that $5,000, right? That's because that's the fair market value when you place it in service. Lower of cost or fair market value, right? And you could depreciate that over 5 years. Depending on the type of vehicle, it may qualify for things like bonus depreciation, but that's probably beyond the scope of this exercise here. Commissions and fees, right? You pay commissions to folks, often salespeople. Maybe you have a sales force to sell your stuff, and maybe give them a 10%, commission on what they sell or something. Or actually, that's really dumb for t-shirts. This is a failing business apparently. It doesn't look like it's going to make it if you're having to sell salespeople 10% commission to sell t-shirts. But contract labor, these are 1099 folks that you pay who aren't your employees, but they do some kind of service for you, right? Let's say you pay some guy $1,000. Depletion, that's more for oil and gas drilling, not really relevant for most businesses. Depreciation, though, right? If you have assets or machinery you use in your business, the IRS generally requires you to capitalize those things. Like, let's say you buy some $25,000 machine for your business, right? It's your manufacturer or something. IRS isn't going to let you deduct that all in year one. Why? Because you're going to get the benefit of using that machine over the next, however many years, right? As opposed to the wages you pay your employees, you get the benefit for those wages. You get the benefit of their labor this year, right? So you can deduct it all this year, right? Same thing theoretically with the advertising, right? You pay for the advertising, you're going to get that entire benefit for whatever ads you run today in the very near future, right? Compare that to a big old machine. It's not the case. IRS makes you capitalize it and then take a deduction for a portion of that machine's cost over time. Okay, let's imagine there's no such thing here. Employee benefit programs. That's like if you non-pension related employee benefits, like maybe a group health or life insurance plan or something like that. Insurance other than health, like, so for example, if I'm a CPA here, I have to pay for amongst other kinds of insurance, I pay for something called E&O insurance, errors and omissions insurance. This is basically in case someone at my in case I or someone in my company makes a mistake on a client's tax return or something, and they come and sue us, malpractice, well, I have coverage through errors and omissions insurance, to protect the company in that case. Now, thank the Lord, I've never had to use it, but that's an example of, maybe an insurance that a professional like a CPA or an attorney or, professional engineer, an architect might have, right, to protect themselves. Interest, mortgage interest, you're probably not, unless you own the building that you operate your business from, you're probably not going to have mortgage interest. But you might have other interest, right? Let's say you have a credit card and a business credit card, and all the purchases on that credit card have been used to for your business, right? Business expenses, nothing personal. You can deduct that interest, right, on that credit card that you've paid during the year, right? And that would be reflected in your books if you've connected your credit card account to your, your QuickBooks or whatever. Okay, so let's say you paid a couple $100 in credit card interest, whatever. Legal and professional services, right? These are your accounting fees, tax rep fees, lawyer fees, things like that. I don't know, $3,000, let's say. Office expense, paper, ink, maybe stuff for the employees, birthday, kind of casual type stuff, right? Pension and profit sharing plans. Obviously if you're kind of just a sole proprietor here, it's just you, you probably don't have employees, so you're probably going to have too complicated a thing here. But, if you did make contributions to a pension or profit sharing plan, employer contributions to your employees, then that would go there. Rent or lease, right? You rent a car, vehicles, machinery, equipment, goes there. Other business property, like maybe you rent an office space, right? Maybe it's just you rent a little, I have an office here that is just me in this particular room. Other staff are in other rooms and other staff work remotely, but let's say you pay $600 for a little room for the month, right? So times 12, what's that? $7,200, right? So you can have an office front, repairs and maintenance. Again, you probably don't really have that unless you own the building you're in. Supplies, I mean, that could go in here too. I mean, oftentimes the supplies expense is so small, right? For a small business, it's like how much you're really spending on pens and ink and stuff during the year. But let's say $200. Taxes and licenses. Maybe this is your business, you know, uh, license, right? Maybe this is if you're in California, you pay an $800 franchise tax to the state every year if you have an LLC. Stuff like that. But if not, if there's nothing there. Travel. If you take a business trip, right? You go to a conference, right? You visit a client out of state. You can deduct, that flight and that lodging, right? What gets a little dicey is when people kind of mix business and pleasure, but that's probably beyond the scope of this video. There are ways to write off part of those trips, right? Deductible meals. Okay, so if it's for your employees, if you do have employees, you can deduct it all. Let's say it's employee meals you bring into the office or something. If it's meeting a client for lunch or something, that's 50%. Utilities, obviously if you own the building that you operate your business out of, that's that. If you rent and your landlord charges you a portion for your, the building utilities, somehow that would go there. You could also put maybe your phone system. If you have a soft phone system like we use Ring Central, for the office, or if you have, you pay for your own kind of like internet line in the office, that would be an example. Utilities, wages, obviously wages you pay your employees. Other expenses, don't be ashamed, right, to put stuff in other expenses if it doesn't fit into any of these other lines. A big one, especially for a professional service provider, would be education, right, to keep yourself and your staff sharp. In my world, when it comes to changing tax laws or something like that. So don't be afraid to put something there. And then you're going to add all the expenses. Oh gosh, I'm going to add these up. All right, total expenses, $36,300. Okay, I added up everything from line 8 here all the way to line 27. Okay, in this fictitious example, $36,300. Tentative profit or loss, you subtract this number from that number. Okay, you get 31,700. Okay, so and I just made these numbers up. That's probably a little bit low. That's like a 31.7% profit margin. That's probably a little low for a one-person company. For my company, Choice Tax Relief, like our profit margins are like, in that 30 to 40% range, right? And we have more. I obviously have more costs than a one-person company. Like the biggest one is payroll, right? So that's probably a little low, and this is a little fictitious, but just to kind of give you an idea here. Okay, and then if you use your home or a part of your home for your business, and you have to use this part of your home regularly and exclusively, okay? So the fact that you're answering emails on your bed sometimes doesn't mean you can write off your bedroom as your home office. But if you have a dedicated space, the only thing you do here, it could be a room, it could be a partitioned off part of a room. The only thing you do in this space is you work on your business, okay? And you do it fairly regularly, right? Then you can take all your housing expense costs. Well, first you figure out what percent of your entire home is attributable to this space, right? Let's say it's a 10 by 10 room, 100 square feet. Let's say your entire apartment or whatever is 1,000 square feet. Right, so 10% of your apartment is a home office, and let's say you pay $2,000 a month for rent, so $24,000 a month or a year for rent times 10%. That's $2,400, home office expense. Okay, so there is a simplified home office method that basically gives you just say the square footage of your home office. No more than 300 square feet. Multiply that square footage by $5. Boom. That's your home office expense. You can kind of see which one works better. I will say that if you do own your home and you use the actual method for the home office, you should be taking depreciation as well and including that in your home office expense. Okay. So anyway, line 31, you're going to subtract the home office expense less the tentative profit or loss from line 39. So we get 20,300, right? So, and then down here, basically, if you've put all the money into this business, right, and then your investment is all at risk. Okay. I mean, this gets into some more technical tax stuff, but basically you don't have to really worry, oh, is my investment at risk or not? It's at risk if you're the one basically putting all the money in and running this whole business. Okay, here's cost of goods sold. I don't want to get too deep into this, but here you would select the method if you track inventory in your business, like t-shirts or something, right? Because let's say you sell t-shirts, when you buy those t-shirts or produce those t-shirts, you can't deduct that cost you paid to buy the t-shirts or the cost to produce those t-shirts just when you bought them or produced them. Okay, you have to deduct that cost as you sell the actual shirts. Okay, and with this question, those t-shirts that you have in your office or your warehouse, that's called your inventory. Okay, this first question here is asking, how do you value the inventory on your books? Probably cost, right? What you paid to buy those t-shirts. Let's say you're just buying them and reselling them. Okay, and let's say that at the beginning of the year, you had $10,000 worth of t-shirts, okay, in your inventory. And let's say you bought, 15,000 more. And let's say there's no cost of labor to make the shirts because you're just buying them, right? There would be cost of labor if you were producing them, theoretically, unless you were doing all the labor yourself, because you do not include amounts paid to yourself here. Materials and supplies, again, if you're kind of producing your own goods, then you'd probably have something here. In this example, we're just saying we're buying them. And actually, let's bump this up a little bit. Let's bump this to 25,000. And then other costs, you may have those. And then inventory at the end of the year, right? Let's say you only have $5,000 worth of shirts at the end of the year. So what was your cost of goods sold, right? Well, actually, I skipped a step. You got to add lines 35 through 39 here, right? So if at the beginning of the year you had $10,000 worth of shirts, you bought another 25,000, right? So for a total of 35,000, right? Total purchases, including what was left, this year plus what was left over at the end of last year. But if you only have $5,000 worth of shirts left over in inventory at the end of the year, what was your cost of goods sold? It was $30,000, right? And that's what I put up here. Okay. The car thing, right? If you're claiming a car expense, okay, on line 9, which we are, okay, and you're not required to file Form 4562, which is the depreciation form for this business, fill this information out. Okay, so just ask you basic questions. When did you place your vehicle in service? Let's say, beginning of the year. Total number of miles you drove during 2024, right? Let's just say 10,000, for business. Oh, and by the way, the commuting thing, you can't deduct commuting miles, okay? So that's something I do want to point out. So basically, the miles from your home to your office, right, where you work every day, you can't deduct that. Okay, so let's say you had like 5,000, or let's say you work close, you live close to work, 2,000 commuting miles, 8,000 other. Then they ask you some questions down here. Was your vehicle available for personal use during off-duty hours? And don't freak out. It's okay to answer these yes, right? If it's just say the truth, right? If that's your only car, right? Yeah, it's going to be available for personal use during off-duty hours. Do you or your spouse have another vehicle available for personal use? Answer it honestly. Let's say no. Let's say you live alone. It's your only car. Do you have evidence to support your deduction? Sure. Yes. You're supposed to keep a contemporaneous mileage log, right? And there's apps out there these days, to help you with this, right? But, because so many people abuse the mileage deduction, that's why the IRS wants you to keep a contemporaneous mileage log. If yes is the evidence written yes, let's assume you have a log, you're doing things correctly. These other expenses here, I didn't put anything here. But this is where you would list them. And folks, I'm telling you, if you know you had an expense that you incurred for your business, ordinary necessary business expense, you can just put them on the other expense line if they don't fit into any other line. Okay, don't be shy. Like I said, education is a big one, especially in professional services. But we have people who they're I've had folks, they're in the real estate business, they do like flipping and wholesaling and all this stuff, and they pay big bucks to some guru or something, to learn the latest and greatest tactics or marketing tactics on how to get leads and deals and stuff. I mean, some folks may scoff at that and say, "Oh, that's a scam." Hey, they paid that money, in order to improve their trade, right? To get better at what they're doing, and that counts, even if that's a big figure that they paid some guru. So I have no problem putting that as an education expense on there. So now I will say though, it's easier to defend if you have an existing business. We have a lot of folks who pay money, to some program or something, but their business never gets off the ground. Yeah, in that case, it's probably not something that you can legitimately deduct. Anyway, folks, here is your Schedule C. That wasn't too painful. We got this done in a little over half an hour. If you have any questions about Schedule C, hey, I welcome it. Leave it in the video description below. If you like this video, what are some other tax forms you want me to walk through and leverage my years of experience as a CPA? Let me know in the comments. Folks, thank you so much for watching. I have some other just kind of general tax videos here on the left-hand side of the screen for your education and enjoyment. Yeah, thanks, folks. Happy tax season. Happy tax filing. See you in the next video. Bye-bye.